Hello everyone and welcome to the channel. When an economy at war shows double-digit growth and record stock market highs, you're not looking at a miracle. You're looking at a system on steroids and hoping the heart holds. Israel just posted quarterly growth above 12% compared to the previous quarter, beating even optimistic forecasts. Consumer spending is up, exports are pushing forward, domestic investment is surging, government expenditure is growing, stock indices are near record levels, and the shekel has strengthened hard against the dollar. On paper, it looks like a success story. In reality, it's a case study in how far a free market democracy will go into hard protectionism and state steering when survival, security, and political optics demand it. Here is where the story stops making sense if you still believe in textbook liberal economics. Let's start with the basics. Physics and money, not speeches. War is expensive. Mobilization costs, munitions, logistics, compensation, rebuilding, reserves, all of that has to be paid by someone. In Israel's case, a big part is being financed via higher public spending and a very deliberate shielding of key sectors: tech, defense, construction, and consumption. At the same time, capital inflows and diaspora support help stabilize markets. That's why you see this strange picture. GDP jumping by more than 12% quarter on quarter, government spending growing, stock market indices setting records, and the national currency strengthening by double digits against the dollar. On a pure macro level, it looks like a booming emerging market, not a country sitting in a permanent security crisis. But if you remember only one thing from this video, let it be this: war growth and healthy growth are not the same animal. One is fueled by real productivity and long-term demand. The other is driven by budgets, fear, and political decisions. Strip out the defense orders, special programs, subsidies, and emergency measures, and the trajectory looks much less heroic. Now to the players and incentives. Israel's leadership has made a clear choice. Forget about ideological purity. Use the full toolbox of state intervention. That means protection of key industries, targeted support for exporters, active management of investor confidence, and a very clear message to markets. Whatever happens on the battlefield, the financial system will be stabilized. Officially, it's still a liberal, innovative economy. In practice, it's textbook emergency Keynesianism with a national security accent. The US likes this model as long as it keeps Israel stable, buys American tech and defense products, and remains a regional outpost of Western capital. For Washington, doctrinal talk about free markets has always had a footnote. Exceptions are allowed for allies, wars, and useful clients. This is the part no politician wants to explain on TV, because then voters start asking why their own country is not allowed the same flexibility. Europe, as usual, watches and lectures. Publicly, EU officials still repeat mantras about rules, competition, and fiscal discipline. Privately, half of the bloc is copying the same approach: subsidies, industrial policy, defense spending, green protectionism. Israel is simply more honest about it. Priority is security and growth, not ideological loyalty to globalization. If you're in Germany or France, I'm curious how this looks from your side, given what's happening with your own budgets and debt levels. Russia and Iran view this economic resilience as a problem. Sanctions, pressure, and conflict are supposed to weaken an opponent, not push it into a new investment cycle. For them, Israeli markets hitting record highs during conflict is a signal that financial tools and limited escalation are not enough to break the system. On the other hand, permanent mobilization and high defense dependency create long-term vulnerabilities: brain drain, social fatigue, political fragmentation. For ordinary people, especially in a small, tense country, this war boom has a double face. On one side, jobs in tech, construction, logistics, and defense are supported or even expanding. The currency is strong, imported goods are more affordable, and official forecasts talk about around 5% GDP growth in the coming years. On the other side, there is the bill no one reads from the podium: higher long-term public debt, future tax pressure, housing distortions, and a whole generation tied to a security-first economic model. This is where the story stops making sense if you imagine that after the conflict everything will quietly revert to normal neoliberalism. It won't. For the Baltics and the rest of Europe, the Israeli case is a useful warning. In a serious crisis, your government will also temporarily forget about free market dogma and start protecting sectors, directing investment, and pumping money into whatever keeps the system from cracking. The question is not whether the state returns. The question is, in what condition, with what competence, and with how much debt on its back? In cold structural terms, Israel is showing us the future, states that publicly swear loyalty to global markets, while in practice building hard protectionist cores around security, energy, food, technology, and finance. The numbers look impressive now, but the real test is simple. Can this model survive when the geopolitical adrenaline wears off and investors start counting, not applauding? Thank you for watching. Take care of yourselves and your loved ones, and try to remember slogans don't power grids, systems do.